Are rising mortgage rates making it feel like owning a home is out of reach? Well, what if I told you there's a way to get a lower house payment at least for the first couple of years? It's called a seller-funded buydown, and this strategy is making a big comeback in today's market. So in this quick video, I'll explain what it is, how it works, and how it could save you thousands of dollars on your next home. Let's get into it. Sometimes sellers want to make their home more attractive to buyers, so they offer a credit at closing. But instead of just using that credit for closing costs, there's a smarter option. It's called a temporary rate buydown. Here's how it works. The seller gives a credit at closing. That credit is then applied to your mortgage payment, and it lowers your monthly mortgage payment for 1, 2, or 3 years. After the buydown ends, your payment goes back up to the normal rate. The lender handles all of the details behind the scenes, and the seller credit covers the difference. So you get a discounted house payment while you settle in, save cash, or wait for rates to drop. Let's break it down with an example. Say you're buying a home for $250,000 and the interest rate is 7%. Your normal principal and interest payment would be about $1,663 a month. But with a seller-funded buydown, that payment goes down temporarily. In year 1, your payment could drop to about $1,342. That feels like having a 5% interest rate. In year 2, your payment could go to about $1,498. That's like having a 6% interest rate. And in year 3 and beyond, your payment resets to the original $1,663 at the full 7% rate. You might be wondering, how much does the seller pay? So let's do the math. In year 1, the seller covers the difference between the $1,663 and the $1,342. That's about $321 a month. Over 12 months, that's a savings of $3,852. In year 2, the seller covers the difference between $1,663 and $1,498. That's about $165 a month. So over 12 months, that's about $1,980 saved. So in total, the seller gives a credit of about $5,832 to cover your lower payments. This strategy helps both buyers and sellers. For buyers, lower payments while you get settled in, extra cash for furniture, repairs, or savings, and the chance to refinance later if rates go down. For sellers, it attracts more buyers. It helps their listing stand out, and it gets the home sold faster without dropping the price. It's a win-win. There's a few things to keep in mind though. The seller credit can't exceed program contribution limits. The interest rate never changes, only the payment does during the buydown. You still have to qualify based on the full payment after the buydown ends. And this works best in markets where sellers are more motivated to negotiate. So if you've been waiting for rates to drop, a seller-funded buydown could be the short-term solution to make home ownership more affordable right now. It helps you ease into payments, keeps more cash in your pocket, and still gets the home that you love. If you found this helpful, like, follow, and share it with someone who's house hunting. And if you want to see how this could work for you, send me a message or schedule a call. We'll review your options, run the numbers, and build a strategy to make your next home more affordable.